Welcome to the Nifty Noon Podcast. We're here to take a deep dive into the really critical developments from the past week, all sourced directly from our daily newsletter. Our mission, as always, is for you, the well-informed learner, to help you cut through all that digital noise and just get straight to the essential nuggets of knowledge. And wow, this week's stack of sources. It reads less like a newsletter and, honestly, more like some kind of geopolitical thriller. It really feels like we hit a major inflection point in the crypto landscape.
Absolutely. It was quite the week.
Yeah, we saw these huge centralized players making really aggressive, high-stakes moves. You had OpenSea, the king of NFTs, making this massive pivot just to survive, it seems. And then Coinbase basically transforming itself into a full-stack investment powerhouse, like overnight.
Right. And at the same time, you've got the political side delivering that absolute earthquake with the CZ pardon.
Exactly. And all this is happening while legacy finance is just quietly, relentlessly expanding its crypto footprint in the background.
It really felt like a week where strategy and regulation just collided at full speed.
Yeah.
What we're seeing, I think, is these centralized players scrambling. They're trying to adopt decentralized finance tooling because they recognize that's where the future of volume and, frankly, growth lies.
Because the big guys are making DeFi plays.
Yeah, and Washington is directly influencing market momentum. But sometimes it feels almost counterintuitive to the institutional adoption that's also happening.
Okay, let's unpack this then. Where should we start? Maybe with that first big strategic pivot we documented.
Sounds good. Let's start there.
All right, so let's kick off with the big news from OpenSea back on October 20th. The perennial giant of the NFT world announced this really grand pivot.
Yeah.
They're fundamentally changing their whole identity.
Yeah, it's huge.
They're shifting away from being just an NFT marketplace to what they're now calling a trade-everything multi-chain crypto aggregator.
It is a massive strategic shift. And, well, it's basically OpenSea admitting that the whole NFT vertical on its own isn't enough for survival anymore. Our newsletter really highlighted the hard numbers behind this. The pivot was pretty much driven by their recent platform volumes. Token trading, not NFTs, actually accounted for over 90% of their, $2.6 billion total volume that month.
90%.
90%. So NFTs have effectively become just a niche, even on their own platform.
So, okay, they're chasing the volume. That means they're going head-to-head with established DXs, decentralized exchanges.
Exactly.
Their new platform, it's non-custodial, already supports 22 different blockchains, and it aggregates liquidity from major DXs like Uniswap. But wait, if they're just aggregating liquidity from others, doesn't that kind of cut them out as a profitable middleman? Like, where's the competitive moat?
That is the critical question, isn't it? They're trying to build the front door, basically.
Yeah.
The best user interface for this whole multi-chain world.
Okay.
And their strategic bet, it seems, is really on the long-awaited the SEA token. It's now officially confirmed for Q1 2026.
Finally confirmed.
Yeah.
And the tokenomics.
Yeah, the proposed tokenomics look heavily community-focused, 50%, half the total supply, allocated directly to the community. And they specifically mention considering OGs and rewards program participants meaningfully and, quote, separately.
Okay, so that sounds like they're trying to reward their existing high-value users, but also attract new volume at the same time.
Precisely. And the launch utility kind of backs that up. 50% of the platform revenue will apparently be used to buy SEA off the open market.
Interesting. By pressure.
Right. And users will be able to stake their SEA behind their favorite collections or tokens to sort of direct platform rewards.
Got it.
And just to add a bit more context here about the whole infrastructure arms race happening, the same day, our newsletter also noted that that payments-focused blockchain developed by Stripe and Paradigm raised a huge $500 million in fresh Series A funding.
Wow, $500 million.
Yeah. So serious money is pouring into the infrastructure needed for these multi-chain plays. OpenSea absolutely knows they need to evolve or, risk becoming irrelevant.
Okay, that definitely sets the stage for the next big move we tracked. Moving slightly south in the ecosystem map, October 21st saw us shift focus over to Solana. Meteora, which is a core liquidity protocol there, announced a pretty robust new launch toolkit. And this was right before its own MN token generation event, the TGE.
Right. We should probably pause quickly for you listening here.
Yeah.
TGU just means token generation event. It's the moment the tokens officially launch and become available.
Good clarification.
So Meteor is really positioning itself as like a foundational builder for the whole Solana ecosystem. And they showcased their new product by dropping 3 major upgrades, all designed to simplify the launch process for other projects. It's essentially becoming a comprehensive platform as a service for anyone wanting to launch on Solana.
What are the tools exactly?
Okay, so they unveiled presale vaults, which allow for custom capital raising conditions. Then there's Meteora Invent, which is basically a toolkit to handle all the technical plumbing, the tricky bits of launching a token. And finally, dynamic fee sharing, a non-custodial system for setting up unique fee structures. They basically built the tools they needed for their own launch.
That makes a lot of sense. Use your own product first. Now let's talk about their specific TGE structure, the Meet token launch itself.
Okay, so the Meet TGE features a fully unlocked airdrop. But, and this is key, it's only going to a very specific high-conviction group of users.
Not just a free-for-all.
No, exactly. It's targeted at liquidity providers, holders of the old Mercurial token, MER, and Jupiter, JUP stakers, and importantly, only those who were captured in a snapshot taken way back in June 30th, 2025.
June 30th, 2025. Wow, that's looking back quite a way. Rewarding long-term believers.
That's the idea. It's a mechanism to reward that long-term commitment on Solana and at the same time prove out their own platform's capabilities through their launch.
And speaking of ecosystem momentum and maybe some slightly stranger news, this same day, October 21st, delivered what felt like the biggest headline bombshell, though it actually turned out to be the prelude to the next day's huge corporate strategy news.
Right, the NFT purchase.
Yeah, Coinbase acquired the Aponley NFT from Cobie for $25 million USDC. $25 million. They literally paid this massive sum just to compel the return of a popular podcast. It felt so bizarre, but also incredibly aggressive as like a cultural power play.
It definitely was a cultural statement, yeah. But you're right, it was also a massive signal flare. Because that leads us directly into October 22nd and the formal announcement of a much larger and clearly related acquisition by Coinbase.
That's right. The next day, Coinbase announced they acquired the on-chain private investment platform Echo. The price tag was around $375 million, a mix of cash and stock.
Quite a sum.
And Echo, as you pointed out, was founded by the very same Jordan Cobie Fish who hosted Uponly. Echo had already helped projects raise over $200 million across something like 300 deals. So yeah, this wasn't two separate stories at all. It was one big, coordinated power play.
Absolutely. If you connect the dots here, Coinbase's stated goal, what they're telling everyone, is they want to democratize early-stage investing. They want to build a, quote, full-stack solution for capital formation in crypto.
Full stack, okay.
And Echo's public token sale platform, which is called Sonar, is going to be integrated directly into Coinbase. The plan is to eventually expand it to support things like tokenized securities and even real-world assets.
So are we basically watching the birth of the crypto world's answer to Goldman Sachs,
Okay.
a compliant full-service investment bank?
I think that's exactly the strategic thesis they're operating under. They're building this mechanism to handle the entire process right from idea incubation and early capital raising using Echo and Sonar, all the way through to listing and secondary market trading on Coinbase itself, all compliant, all in-house.
And they're clearly willing to spend huge amounts of capital to achieve it, both on the hard tech, like acquiring Echo, and on the, let's call it soft influence, like paying $25 million to revive the Uponly podcast. They want to own that entire stack.
Definitely. And meanwhile, while Coinbase is focusing on this early-stage capital formation, our newsletter also highlighted some important market context happening in parallel.
Right, the Bitcoin ETFs.
Exactly. Big Bitcoin holders are apparently shifting significant funds into those Wall Street ETFs. This follows that rule change back in July that allowed for tax-free in-kind BTC transfers into the ETFs. So the institutional on-ramp is getting smoother and more attractive, even while these corporate giants are busy building their own full-service crypto investment banks.
Things are moving fast on multiple fronts. Okay, now we move to October 23rd. The focus shifts back to another high-profile token sale, this time the hype building around MegaETH. That's an Ethereum Layer 2 solution aiming for a really impressive 100,000 transactions per second.
Yeah, and this is where Coinbase's brand new acquisition, Echo Sonar, immediately proves its value. The public token sale for the Mega token kicks off October 27th, and guess where it's being hosted?
Let me guess, Sonar.
Exactly. An English auction hosted directly on Sonar, the platform they just bought from Cobie. It's operational like right away. Talk about synergy.
Okay, let's really dig into this auction because the mechanics they've set up are fascinating. It feels like a masterclass in price discovery, but also filtering for specific types of buyers.
They certainly are interesting. MegaETH is offering 5% of its total supply in this sale, which is 500 million tokens.
Right.
The auction has this remarkably low starting price, 0.0001 per token. That equates to just a $1 million fully diluted valuation, or FDV.
Just a million FDV start. That's incredibly low for a project with this kind of hype. And just to remind everyone, FDV, fully diluted valuation, is the total market cap if every single token were circulating immediately.
Precisely. But then the ceiling price is set at 0.09999 per token, which works out to a $999 million FDV. So a huge potential range there.
Almost a billion at the top end.
Right. But here's the really strategic filter they've put in place. To incentivize long-term holding, any purchasers who agree to lock their tokens for 1 year get a 10% discount.
A 10% discount for locking.
Okay, but here's the crucial part. That 1-year lockup isn't optional for everyone. It is mandatory for all accredited U.S. participants.
Mandatory lockup for U.S. participants.
Mm.
Okay, that's not just about conviction then, is it? That sounds like deliberate regulatory risk mitigation.
I think that's exactly right.
They're structuring the sale to primarily appeal to long-term holders, yes, but also probably to stay clear of immediate regulatory heat regarding public offerings in the U.S.
That's the strategic insight, I believe. It feels like intentional regulatory maneuvering combined with a filter for commitment. And it's especially notable when you consider that pre-launch futures trading on platforms like Hyperliquid are already implying a multi-billion-dollar valuation for MegaETH, somewhere around $6 billion FDV last I saw.
$6 billion implied. Wow. So the team is forcing this sophisticated price discovery process while actively filtering for conviction and navigating regulations. Clever.
Very clever. And here's where it gets really interesting on the global stage again. The very same day MegaETH announced these sale details, regulators over in Hong Kong officially approved the first ever spot Solana ETF.
A spot Solana ETF in Hong Kong, also set to begin trading on October 27th, same day as the MegaETH sale starts.
Exactly. Solana is clearly having a huge moment, right? And institutional access is following that momentum globally now, not just in the U.S.
The speed of global institutional product approval is just, breathtaking sometimes.
It really is. Which brings us neatly to the biggest political story of the week, the one that dropped on October 24th.
Right, the pardon. President Trump issued a full and unconditional pardon for the former Binance founder, CZ Changpeng Zhao.
Yeah, this is obviously a high-profile and, let's be honest, highly contentious development. Zhao had previously pleaded guilty to violating the Bank Secrecy Act. He served a 4-month prison sentence earlier this year.
And the White House statement.
The White House statement was pretty clear in its framing. It claimed the pardon effectively ended the war on crypto that they say was prosecuted by the previous administration. They specifically noted Zhao was pursued, quote, despite no allegations of fraud or identifiable victims.
Okay, so that's the administration's framing. What was the immediate fallout? Because there are definitely two very loud, very different sides to this story.
Oh, absolutely. On one side, you had CZ expressing his gratitude, releasing a statement saying he will, quote, do everything we can to help make America the capital of crypto.
Helping make America the capital of crypto.
But on the other side, the political reaction was immediate and incredibly sharp. Senator Elizabeth Warren, for instance, strongly criticized the move. She stated that CZ pleaded guilty to a criminal money laundering charge and alleged he lobbied for the pardon, calling the decision itself corruption and lawlessness.
Strong words.
Very strong words. And look, our sources require us to report both perspectives impartially here. It really just highlights the stark political division that still exists around crypto regulation and enforcement.
Understood. And the market reaction. Was there one?
Oh, yeah. Immediate. Binance's token BNB jumped about 5% pretty much as soon as the pardon report started hitting the wires.
A clear market signal. But amidst all this political volatility, the theme we keep seeing in our newsletter sources, institutional adoption just keeps rolling forward, doesn't it?
That's the key synthesis, I think. You have this high political drama, these contentious pardons happening, causing short-term market jolts like that BNB jump. But underneath it all, Wall Street's adoption machine just seems to be running independently, almost relentlessly.
Like what?
Well, Fidelity, one of the world's largest asset managers, is now offering spot Solana trading and custody services to its clients. And even Rowe Price, a real legacy asset manager founded way back in 1937, just filed for an actively managed crypto ETF.
T. Rowe Price.
Yeah. These massive established players are moving forward, seemingly regardless of the day-to-day political winds in Washington.
Okay, so if we try to synthesize this whole packed week, we're seeing these centralized giants like Coinbase and OpenSea making really aggressive moves into DeFi and token sales.
Yeah.
They seem to recognize they have to own that capital formation stack to survive and grow in the future.
That seems clear. And simultaneously, you have political forces using these very high-profile cases, like the CZ pardon, to signal broader policy shifts or perhaps play to certain bases. And that causes these immediate sharp market reactions, like the 5% BNB jump.
Right.
But the sources also show this parallel reality running alongside it all. These massive legacy institutions, Fidelity T, Rowe Price, they're embracing crypto ETFs, they're building custody solutions, they're bringing potentially vast amounts of capital into the ecosystem through these smooth, compliant institutional channels.
Okay, so that sets up a really interesting tension.
It does, and it raises, I think, an important question for you to consider this week, looking back at all this evidence. When you weigh it all up, the immediate, say, 5% market jump from a political pardon versus the quiet, structural, almost inevitable seeming entry of multi-trillion-dollar asset managers like Fidelity and T. Rowe Price, which force do you think is ultimately driving the market more right now? Is it Washington's constantly shifting, often unpredictable political winds? Or is it Wall Street's institutional entry and the massive patient capital that brings with it?
That's a really challenging question. Political signaling versus fundamental institutional plumbing. Definitely something worth mulling over all week. Thank you for joining this deep dive.
It was a pleasure. And remember, you can follow Nifty Noon on X and definitely subscribe to our newsletter on Substack for these essential updates delivered daily.